Hi, very warm welcome. It's the first week of January. I'm Roy Walker, and this is a presentation on building an international investment portfolio, mostly using low-cost index trackers. So if you follow my blog, you'll realise I don't do a lot of videos. When I do get round to it, I'm trying to cram a lot of information in. I thought, since this is a topic that have been asked to cover in a bit more detail by many people over the last couple of years, that I'd try and fold in at least a slide on some very key topics. My apologies to people, to the audience who are already extremely familiar with all this material, and my apologies to people who are brand new and beginning, and some of these terms may be completely alien, but hopefully I've covered enough of the subject in enough depth to be of some interest to some people. Without making this a formal agenda, these are the areas that I'm going to be covering briefly. First of all, something called evidence-based investing. Difference between investing and trading. The key asset classes, how we use them for diversification and how they behave differently. Very quickly, what are bonds, and how we match our asset allocation to our risk profile. How we stay relaxed by matching our investment strategy to our time horizon, which is pretty crucial. Using a risk return or a return volatility chart to help build our portfolio. Key differences between passive and active investing. Understanding where we use index trackers and the situations where we may choose not to. Briefly touching on the concept of core and satellite investing, some criteria that we might use for selecting funds to go into our portfolio, touching on how we manage currency risk in our portfolio, and finally understanding portfolio cost. What does it actually cost us to build a portfolio? So these are some of the key areas. If any of this is interesting, please do stick with me. I've got about 30 slides or so to go through, so it may be a bit of a marathon session, but hopefully there'll be something in there for most of you. Okay, before I kick off, let me just say this is not investment advice or an investment recommendation of any kind. It's simply an under the hood simplified walkthrough of a methodology, and this is just one methodology of many that are equally valid depending on your situation, your circumstances, your investment objectives, what have you. All investments mentioned in here are for illustration only, simply as an aid for education and discussion, and the portfolio that we'll be looking at is based solely on the specific situation and requirements of a hypothetical investor. Unlikely to be applicable for you, although some of the key concepts hopefully are. And the usual thing, any liability for anything is disclaimed in entirety. Always consult a professional advisor before making any kind of investment decision. So getting that out of the way, let me give you a quick background on me, in case you don't already know. Started out as an engineer many years ago, moved into the financial arena when I did my MBA in 1992. I've spent many years working in Southeast Asia, now based in the Middle East, and I work with expatriates, so investors and clients from many nationalities. With my engineering background, I'm very analytical and process driven. Some clients appreciate it. I'm sure some it drives bonkers. But one of the things that I have learned over the years is that understanding is the key to reducing uncertainty and investor stress. So the more we understand about what's going on under the bonnet, the more we can actually relax that, yes, okay, everything's on track, I don't need to worry, yeah, we're doing the best that we can. So that's really my philosophy and the modus, the reason for this presentation. So here's our objective, pretty descriptive, at least 1,000 words worth there. But let's talk about what we're trying to achieve. So we're trying to achieve calm and stress-free investing. We've all got busy lives. We want our money to grow. We don't want to be taking any unnecessary risks, but in the background we just want to get on with the rest of the stuff going on in our life, our family, our jobs, our career, all of that kind of stuff. We don't want to be stressing out, worrying about how our money is working for us in the background. As mentioned, we want to understand how and where our money is invested. The more we understand, the more that helps us get rid of the uncertainty that we're not aware of what's going on. We want to invest internationally, and we want to manage away currency risks. A couple of slides on currency risk. It's an area, particularly for international investors, that's important, and quite often it's understood. We don't trust fads and fashions or this year's superstar fund managers. If we're into the next big fund management team or fund manager, all that means is next year we have to pick the next one. Next year we have to pick the next one. So we don't want to be relying on trying to identify who's going to be the winning stock picker this year or next year. In fact, we want to be able to ignore the financial headlines completely. Be relaxed about the day-to-day manic fluctuations of the market. And we want a strategy that is backed by decades of research and has been time proven over many, many years. Okay, so let's kick straight off with evidence-based investing. So it's a key term. It's been becoming more and more commonplace in the investing industry, particularly over the last decade or so. But actually the phrase didn't originate in the investment arena. It originated in medical practice. So evidence-based basically means, an evidence-based practice basically means a professional practice that relies on academic research and scientific evidence for guidance and decision making. Traditionally, practices that were not evidence-based rely on tradition, intuition, other unproven methods. That's the way that we've always done it. So evidence-based has been around for 30 years, originally medicine, and now it's spread to allied health, education, management, law, public policy, and other fields, including investment management. And the purpose of evidence-based practices are an attempt to encourage, or in some industries to force, professionals to pay more attention to evidence to inform their decision making. And the goal is to eliminate unsound and outdated practices in favour of more effective ones by shifting the basis of decision making away from tradition and intuition and more towards the firmly grounded scientific research. It's all pretty obvious, really, if you think about it. If we're making decisions in any professional practice, we want those decisions to be based on what the data, what the research says, not just a guess on, that seems to be okay because it's what we've always done. Okay, so evidence-based investing, EBI, essentially it's all about what's been proven to work because of the research and the data and the academic study. It isn't, however, an excuse to be laziness, and more as EBI as a term has become more popular in the financial press and the blogs and whatever. We need to be aware that it isn't an excuse to be lazy. So EBI, or evidence-based investing, doesn't mean that all index trackers are always the best investment. It doesn't mean that ETFs are always better than mutual funds and unit trusts. It doesn't mean that low-cost funds are always better than more expensive funds. And it doesn't mean that certain famous investment brands are always better than the others. What EBI and evidence-based investing basically means is that we're using research and data to guide our methodology. So it's not an excuse to illogically ignore huge sections of the investment universe just because some element of research says that low-cost index trackers are better on average than others. So let's just put that out of the way. Okay, what does the evidence tell us then? So, in general, evidence-based EBI evidence, the research tells us conceptually that asset prices are fair. Why? Because in most major developed markets, the price of a share or a price of a stock on a stock market, there may be literally hundreds of thousands or millions maybe of market participants, people buying and selling individual stocks. The likelihood that individual investors might know something that is unknown by the rest of the market is pretty small. So we have to assume markets are efficient, information is widely known, i.e. the price of a stock today is fair because it represents the best estimate of the value of a stock on that particular day with all information known. Hence, logically, it's not possible to consistently outguess the market because the vast majority of active fund managers who are trying to beat the benchmark, the research says that in general they don't. And that kind of underlines the fact that that prices in general are fair. We can't outguess the market reliably over any period of time. Okay. Another key area of research into the academic background of investment theory is that the relative performance of an investment portfolio is mostly determined by the asset allocation. And the asset allocation is the proportional split between the different asset classes. So it might be government bonds, developed market equity, Asia Pacific, emerging market equity, whatever. The split between those broad asset classes will determine the vast proportion of how well our portfolio does against any others in our particular peer group. Since we cannot reliably predict which will be the best performing asset class from one year to the next, we need to use broad diversification so that we can manage the downside risk, we can smooth out volatility, and we can get exposure to opportunities that otherwise we might miss. As I mentioned earlier, there's a lot of research that does suggest when we're identifying investment funds that we want to use, fund selection should emphasize low-cost, passive, rules-based investments, but not necessarily to the exclusion of all others as a first filter. And ideally, we should be tracking market indices or benchmarks that have long performance histories because that is helpful to us when we're doing our analysis and our portfolio construction. So finally, in the long run, markets do go up, but there's no guarantee about investment performance in the short or the medium term. But by taking a long-term time horizon, not reacting emotionally to market fluctuations, we can give our investment strategy the time to deliver the results that we're looking for. Okay, so what are global market indices or indexes? An index is what we call a rules-based calculation of a number. And that may be based on a number of different factors. We're very familiar, if we listen to the financial news at all, we're familiar with what an index is. So we're familiar with the S&P 500. The rule is it includes the 500 largest companies listed in the United States. FTSE 100, the 100 largest companies listed in the UK. ASX 200, the 200 largest companies listed in Australia. And what rules-based means is that every quarter or so, or periodically, when the index is reassessed, if a company has got large enough to be included in the index, then it goes in, or a company has reduced in size so it's not included in the index, then it gets kicked out. So there's no human intervention. It's a rule that drives the constituents of the index and the ratio of the relative holdings within that index, what goes together to make it up, so that if the rules behind the index don't change over time, although we can't predict how an index, what an index what will happen to it, this year or next year or whatever. In general, the behavior of indexes tends to be consistent because the rules have applied, over a long period of time. Let's just talk about MSCI World Index. Whoops, go back a page. So the MSCI World Index is very famous. It's the developed market equity index or shares index that tracks the performance of global developed market around the world. If we look in the bond arena, the Bloomberg Global Aggregate does a similar sort of thing. It's a similar sort of major benchmark for what we call investment grade bonds, so treasuries, government and corporate investment grade bonds from the major markets. So our philosophy here is we've got the benchmark. The research says that in general we can't beat the benchmark with any one particular asset class. So what we're going to be doing is using benchmarks to build our portfolio rather than trying to beat them. Okay, passive versus active investing. Okay, I've actually put these in the wrong order. I'm going to start with active funds. So an active fund, or what we call managed fund, or we might know them as unit trusts, mutual funds, those kind of things, they were the traditional type of investment fund. So we give some fund managers some money, gets pooled with others, it's a collective investment, and the fund managers are the guys or gals that are making decisions about where our money gets invested. And the continued performance of the fund relies on the management team continuing to make good decisions over the years ahead. Now let's just go. So that's a traditional managed fund. If we look at passive funds, a passive fund, rather than active fund where you've got people actively making decisions, a passive fund, there is no human intervention. There are no decisions being made, because the passive fund basically follows an index, or it tracks an index, which we'll remember is rules based. So there's a mathematical formula behind the index, and the fund just tracks the index. So no management team per se, no salaries to pay. Usually what we see as passive funds or index trackers tend to be lower cost, and they're clearly more transparent than a managed fund. So the performance of a passive fund is consistent with the rules-based index. So when to buy and sell, what percentage weighting of the assets within the portfolio, what are the definition, what's included, what's not included, all that kind of stuff. Now, passive investing or index trackers have become synonymous with exchange-traded funds. Exchange-traded fund is just one type of physical structure, if you like, for an investment fund. ETFs in general, true, they do tend to be, majority tend to be passive funds or index trackers, but not all of them. There are some active ETFs because it's a way to bring a financial product to market. Similarly, although generally speaking we think of unit trusts and mutual funds as active managed funds, they may not. There are actually some passive mutual funds and some passive unit trusts. And one thing to think about is that we've talked about the big difference between passive and active is to what extent they are rules based, to what extent there's a mathematical formula or some kind of formula that determines when to buy and sell, if you like. Some of the very best active funds actually are very highly rules based. So the management team have a very self-disciplined set of rules to analyze the universe, identify the shortlist, and then decide when to buy and when to dispose of investments. That process can be very highly rules based. So just because we're not tracking an index per se doesn't necessarily mean that that a managed fund is not rules based, which is one of the reasons why there are indeed very good active funds that are certainly worth a look when we're building a portfolio. It's also worth mentioning that aside from that, passive funds, and indeed the research on the performance of passive funds and active managers not beating the index tends to be for the larger markets, tends to be for the efficient markets. There's a lot of participants, information is known, investments are accessible, that kind of thing. But there are certain themes and asset classes where there may be a justification for a degree of active management, and areas might include Asia Pacific and emerging markets. High yield bonds is another good one. Ethical investing. There are some absolutely fantastic active ethical investment funds that allow investors to express their ethical priorities and considerations in their investment philosophy. We just simply don't get that through an ETF or a passive index tracker. Okay, moving on. Core and satellite concepts. So when we build a portfolio, remember we're building a collection of investment funds together to basically create a portfolio that overall takes us in the direction that we want to go. The concept of core and satellite has been around many years. If you Google it, you get like 1 million hits. Very briefly, this is really all that you need to understand. The core part of your portfolio, that sort of kernel in the middle, that is a long-term foundation of your investment portfolio. So we're talking about the major asset classes, so developed equity, government bonds, that kind of stuff. Generally speaking, because we're talking about major markets and we're talking about, this is the core, keeping up with the benchmark and building the core part of our portfolio based on benchmarks means that we can use low-cost passive investing to do so. So very often you'll see a core part of a portfolio using very often exclusively ETFs or index trackers to create that core part of our portfolio. And indeed, there are actually multi-asset funds specifically for that purpose. So instead of having to choose what equity funds, what money market funds, and what government investment grade bond funds, there are funds that are out there that include everything, and maybe a rules-based or maybe a management team make those decisions on that, and hey presto, we've got our core portfolio, the core, and then all we need to do is just think about what little bit of fun or excitement do we want from the other parts of our portfolio. And that I'm talking about is the satellite. So the satellite area is where in our portfolio we're opportunistically adding other asset classes depending on maybe what's going on in markets from time to time. Maybe there are specific themes or sectors that are attractive to us and we think has a role in the portfolio. So whereas in the core very often we're looking for quality and we're holding for the long term, around the satellite area we might be more likely to be adjusting depending on economic conditions or trends that are emerging or going away. And because of the nature of some of these regions or asset classes, they're somewhat more likely to be actively managed funds. So for instance, as we go into the pandemic, maybe we might have thought that healthcare as a sector might be particularly interesting. So we may have not touched the core part of our portfolio, but we might have gone away and researched healthcare and come up with an attractive, actively managed healthcare fund, to add in to the satellite part of our holdings. Okay. Right, let's go back to basics. What is investing? So investing ultimately is not short-term speculation. It's not what we call trading. Trading is the concept of buying something with the intention of selling it again relatively soon to make a profit. We don't really care what we're buying or selling. Investing is something quite different. So when we're investing, we are actually either directly or indirectly, we are buying a piece of a business or a piece of many businesses because we're buying shares in those companies. So share the way the name share comes because we're taking a share of the business, so we deserve a share of the profits, which is paid out by dividends. Plus, we get appreciation of capital value because in a few years' time, when we sell those shares again, they'll have gone up in price as the business grows. Okay, so by buying shares in companies, we're taking a role in the global economy. We're playing a role in the global economy. And let's just look over the last 40 years, from 1980 through to 2020. The global economy in trillions of US dollars has grown. World GDP has grown from 11 trillion US dollars to 84.6 trillion US dollars. So that's a growth of almost 650% over a 40-year period. Interestingly, we can look at the world market capitalization over the same period of time. So over the same period of time, the value of companies listed on stock markets globally, so we call that the market capitalization, has grown from 2.5 trillion US dollars to 93 trillion US dollars. So the value of businesses globally in 40 years has grown by 3,610%. And over the same period of time, if you look at just the value of the S&P 500, which includes the top 500 companies in North America, which at any particular time may represent up to about a third of listed market cap globally, because some of those companies are enormous. But the S&P 500 as an index has grown from 135 in 1980 to the end of 2020 in 3756. So that's a growth of 2,667% in a 40-year period. And remember, that's just growth of the price of the index and completely ignores the value of all the dividends paid out from those companies over that last 40 years. So the benefit of investing, buying and holding and taking the dividends in the S&P 500 as an example would be absolutely phenomenal if you could afford to do that for the last 40 years. Okay, so to summarize, investing means to participate in the growth of the global economy. Okay, so let's just take that concept further. Let's look at those numbers in charts. So this is exactly the same data as the slide before, I've just charted it out. So the grey box, the grey line, is our world GDP, the gross domestic product of the world, the global economic productivity, if you like. Okay, the orange line is world market capitalization, so the value, the listed value of companies that are listed on global stock markets. And the listed value of the market capitalization is the number of shares in issue times the share price, the number of shares issued times the share price for a particular company. So if our share price is high and we've got lots of shares issued, we're a pretty large company. Now you can see that there are certain periods of time. So if we look at the run up to the dot-com boom and bust, we can see market cap, global market cap peaking in about 1999 and then falling down to 2002 with the dot-com crash, if you like. Then the run up to the global financial crisis, very peaky, world market capitalization, a lot of enthusiasm. Then we had the crash, and by sort of 2008 coming into 2009, quite a substantial drop, and so on. And one subsector of that, just looking at the price index of the S&P 500, is the blue line. So we can see, the S&P 500 peaks before the dot-com boom, crashes again in the global financial crisis. We have a nice run up. But underlining all this is, yes, we have economic conditions where we get a lot of volatility in market cap, i.e. the share price of particular companies, the growth of companies. But underlining that is the world GDP. Economic growth of the world is relentlessly upwards. One of my favourite phrases, we ain't going back to Roman times. And if you think about the reasons for this, the world population is close to 8 billion. A couple of decades ago it was 6 billion. Not just are there more people on the planet, but as a species we're much more productive. So the productive value of a person in an economy has been amplified over that period of time. Similarly, we've got economies that were once developing or emerging that are now developed. We've got whole sections of society that were once impoverished, that are now, we've got growing middle classes in sections of the world where there were none 30 years ago. All of this adds up. So the global production of humanity, if you like, the global economic boom, it's not a straight line by any means, but it's relentlessly upwards. Okay, so that should give us a little bit of comfort if we've got the right time horizon, that it doesn't really matter what happens this year or next year or the year after. As long as we're participating in the global economy, we're going to get a piece of the action over the long term. Okay, so let's look at diversification. So why do we diversify? We diversify because although things are going to be okay in the long run, we can't predict from one year to the next what asset classes are going to be the best performers. So what this chart does is it outlines the performance ranked by percentage growth, the performance of key asset classes over the last 15 years or so. So if we look at, I haven't updated this, although it's the first week of January, I prepared these slides a few months ago. So we look at 2020. In 2020, the first year of the pandemic, the blue box, 22.4. So the blue box is Asia Pacific. So Asia Pacific as an asset class created 22% growth last year. Going into it, 2019, there's no way we could have predicted that. Some people might have had their suspicions, but prediction of markets with any reliability, forget it. Right down at the bottom here, the brown box is US Treasury bills. Not even a percentage growth there, but very safe, very steady investment. Let's look at the red box. So global emerging markets, 18.3% last year. USA large cap, so larger companies. This is in fact the S&P 500, 17.75%. Global smaller companies, almost 16%. Global developed markets, the purple, this is effectively the MSCI World Index. Investment grade bonds, 9.2%. Global high yield bonds, 7.9%. Global government bonds, 5.52%. And if you look, it's completely impossible to predict. So let's look at global emerging markets. Let's look at the red box. 18 2020, 18 2019, minus 15 almost 2018, but 37.2 2017, 11, 14. So we go back to the global financial crisis in 2007, global emerging markets. If you were in global emerging markets in 2007, you might have thought you're an investment genius. A 40% growth, that's not too shabby. Following year, you'd have lost your shirt, more than half your investment gone. But the following year after that, back up again, 78%. Again, just underlining, we don't put all our eggs in one basket. We need diversification across all of these major asset classes. Another way of looking at the same data, and these are the same asset classes, the same data and the same color coding. So we look along here, we can see over the last, so this is a little bit longer time scale, 18 years or so. We look at blue, Asia Pacific, the index. So these are indices because indexes, they're rules based. We've got nice long data. And if we've got the data of the underlying constituents, we can actually go back in time and create an index where there may not have been one a few years ago because we got the raw data to do that. So MSCI all country, Asia Pacific excluding Japan. If we'd invested back in January 02 by 31st of December 2020, we would have achieved 564%. If we'd have been in emerging markets, we'd have got 540%. But look at the volatility. Look at that red line. There we are. There's the run up. Emerging markets. I'm an investment genius. Come into 08. Suddenly, global financial crisis. And look at that peak to trough. That's more than a 50% drop. But if we just sat on our hands, done nothing, we'd have got that all back and recovered, right the way back up there. On the other hand, if we'd have been very safe, very steady, and all we wanted to do is just to invest in US government treasury bills, the brown line, there's that brown line along there to point I, we'd have achieved 77% over the same period of time. But during the financial crisis, wouldn't have even noticed. No volatility whatsoever there during that financial crisis. And what this is really doing is it's underlining that on average, as long as we're looking at the major asset classes, the ones that tend to create the best returns in the long run tend to be the more volatile. The asset classes that are more safe, more steady, less likely to behave like crazy when the world is falling apart, we're much more likely to get very modest returns from those for our long-term holdings. Portfolio construction, in essence, in a way, is choosing enough of the safe and steady, enough of the adventurous, enough of the middle of the road, and putting them together in a mix that works for us and represents our risk profile and our time horizon and gives us that diversification. Okay. I just want to touch on bonds. I use when we're in the investment industry, we use bonds or fixed income or fixed interest as it's very common terminology. But to a typical investor, we may not be really aware of what they are. We're familiar with shares, but perhaps not bonds. Let's just explain what they are. So equities and bonds are the two main sources of business finance. So imagine if you wanted to start a business and you need some capital, how do you raise that? How do you raise that money? Well, number one, you could sell some shares, and your investors would hope for a part of the future capital gain. But to do that, you've given away ownership of part of your firm. You've given away shares in your business. You may lose control ultimately sometime in the future. Or you could borrow money and pay that back from later profits. And the benefit of doing that is that you don't dilute the existing shareholders. So if you borrow money, you pay it back, your obligation is complete, you still own the shares that you owned in the first place. So a bond is just a term for a loan to a company or a government. And I'm excluding business loans from a bank. We're talking about corporate finance here. So a bond is a loan to a company or a government. So buying bonds means that you're basically loaning money. And the borrower of your money is the bond issuer, and they make a promise to pay back the loan at a certain time in the future. And it could be a year away, it could be 10 years away, it could be 30 years away. But they promise to pay that back. And they also promise to pay interest. So as long as you hold that bond certificate each year or every 6 months or whatever the coupon period is, they will pay you some interest for the privilege of them holding your money while you've got that certificate, while the loan is outstanding. So loans to governments of major countries and blue chip, so the larger companies, are considered very safe. So they're what we call investment grade bonds. The likelihood of Apple, which I believe just hit 3 trillion valuation, suddenly defaulting on its corporate debt is pretty negligible. So it would be considered investment grade bonds if you happen to have a loan out to them. And if the safer and steadier the borrower, the less interest rate they have to offer to attract people willing to give them a loan. The other end of the spectrum, smaller, less secure companies, maybe in the early stages of their life cycle, or shaky business proposition, or difficult markets, or whatever it is, more risky companies. The borrower would need to offer a higher interest rate because we're a bit less certain that we're actually going to get our money back when the bond comes to an end. So these lenders, these borrowers, would be effectively offering high yield bonds to the market because they have to offer a high yield to lenders to be able to borrow money. That's it. That's all you need to know about bonds. Okay, basics of asset allocation. Now let's get to some interesting stuff. Okay, so what are we looking at? What are we looking at here? So this grid, we've got two axes. So the axis along the bottom here, this is what we call volatility, which is a way of measuring risk. Because in our investment world, although your typical investor, risk means, oh, the likelihood I'm going to lose my money, we don't really have that per se. The value of the big investment funds can go up and down, but the likelihood of them disappearing overnight, although it's small, it does exist, but it's very small. So the Bernie Madoffs or whatever. But most investment funds, once you get to a certain size, you're pretty sure that you're not going to lose your money overnight, which is the stuff of nightmares to a typical ordinary investor who doesn't really know too much about the market. And as a financial advisor, when I work with clients who haven't done a lot of investing, a lot of the work that I do tends to, in the early stages, is a lot about education, helping people become, more comfortable about what's going on, removing the uncertainty, just having a lot more information about how we put a portfolio together so that we can be more comfortable that we're not going to lose our money overnight. So risk in the financial industry is it's actually what we call the annualized standard deviation of the square root of the variance, or as I like to call it, it's the amount of up and downiness. Okay, so let's look at the left-hand axis. This is our average annualized return in US dollar terms, expressed as a percentage. So what we've got here, let's take D, USA large cap. And by the way, these are the same color schemes here. It's still the same asset classes and the same color scheme repeated here. So the same indexes are charted out here. So if we look at D right here, we can see that it's got a volatility of about 14 and a half, and over the last 20 years. So this data is 20 years to a month ago, 31st of November 2021. The average annualized growth of the S&P 500 over a 20-year period to last month was 8.6%. So again, if we just bought and hold S&P and held it for 20 years, our money would have grown by 8.6%. But we've got relatively large volatility, so 14.65 volatility because it's shares, because it's equity. If we had looked at, for instance, let's look at C here. So global emerging markets, a lot more volatility. So right up in the top right-hand quadrant, a lot more volatility, little bit more growth. In fact, just so happens that the best performing asset class over the last 20 years has been global smaller companies. So not the massive, mega caps, but the smaller and mid cap companies around the world. If you'd hold for 20 years, you'd have got 10% returns over the last 20 years in US dollar terms, but you'd have had to have lived with 17% volatility. Let's just go back and see what that means. Okay, if you were holding that green, so we're looking at global smaller companies, it's this line C, we'd have had to live with volatility like that. So there's a peak, there's a trough during the global financial crisis. That's quite a lot of volatility to live with. Okay, so if we don't need to access our money, we got long-term time horizon, that's fine. But it still makes us nervous when things are going up and down. Okay, let's look down here in the bottom left-hand quadrant. We've got assets that have got a lot less volatility, and consequently less annualized return over our period of observation. So if we look at I, there is our US government 10-year Treasury bills. So 10-year Treasury bills over the last 20 years have delivered average annualized growth of 3% per annum. And for the sake of giving up this higher expected returns, we've been able to benefit by being comfortable that we've got negligible volatility in the long run. And by the way, you can't get much safer than the US government as an issuer. If you want somewhere safe to lend your money, lend it to the US government. Okay, let's look at H. So H here is global government bonds, so bonds from governments all around the world. G is investment grade bonds. So this is not just government, but it's the larger corporates. Yeah, so we can have a look at all that. Okay, so when we're building a portfolio, we've got a mix of all of these different types of assets. We've got some down here that are boring, safe and steady. We've got some up here which are volatile, scary ride, but good expected returns. So when we're building our mix, we're basically saying, okay, so for instance, if I had a portfolio that was 50% of C and 50% of I, the resulting portfolio, the performance would be somewhere in the middle. Okay, so if we had a portfolio that we wanted to make more safe and steady, we'd get rid of investments from this quadrant and we buy more investments in this quadrant and vice versa. And that's all we're doing is just making sure we start with with a good enough diversification of assets, and then finding the right balance that we are comfortable with as investors. Okay. How do we create our portfolio? Some simple steps. The first thing, as I mentioned, we need to understand our risk profile, because the most, if you like, almost the first fundamental decision that we need to make when we're constructing our portfolio is, what is the split between safety and growth that we want in our portfolio? What's our bond equity split? And underneath that, we're splitting out things, we're diversifying to the next level to define our asset allocation, because as we've seen, bonds and equity, there are multiple different types of asset class within both of those. Okay, once we've identified the assets that we want to hold inside our portfolio, then we can start to construct that portfolio. And finally, we can look at the portfolio that we've constructed. Maybe we're comparing perhaps 2 or 3 different portfolios to see which we like the most. But if we've used index trackers or mostly rules-based investments, when we're looking at historical performance, although of course no guarantees about the future, but it gives us, because they're rules-based, it gives us a little bit more comfort that if in certain economic conditions the portfolio behaved this way a few years ago, if those conditions arose again, more likely than not it's going to do something similar along the same lines in the future. We're not putting all our money on fund managers trying to make great decisions in times of economic cataclysms or whatever. Okay, right, let's talk about time horizon. So do you remember a few minutes ago I mentioned that often to new investors or cautious investors or investors who may be approaching retirement, probably the number one thing, risk isn't really about volatility. Risk is about what's the chances of me losing all my money. And that's the thing that really keeps us awake at night. Is my money going to be safe? Well, we can break this question down based on our time horizon. Because what we want to know is, what's the worst case scenario? If there's a market crash, what's the worst that can happen? Okay, so let's look at our time horizon. If our time horizon is short, and I would define that by within 3 years, so I'm definitely going to need this money back within 2 or 3 years. So maybe I'm about to retire, maybe I need it as a deposit for a house, whatever. Definitely need it back. really we shouldn't, if we absolutely know we're going to need that back, if we're at least, have any kind of trepidation about market investing at all, we need to be in the investment solution of cash, term deposits, government bonds, very safe investment. We don't want to be taking any risk. We just want to know that our money is going to be there at the time that we need it. The risk control methodology, really, it's almost not down to us, because we've got consumer regulation, we've got the credit rating of banks and governments. If we're investing our money in government bonds, we kind of know that we're going to be okay. But what's the worst case scenario? If suddenly there's a market crash, the world goes to hell, and we're worried about our money back. If we were 100% in bonds, and let's go back to that. If we're 100% in bonds and we want to retire back here, or we need our money for a business venture or a property deposit or whatever, and it's a global financial crisis and we're in bonds, we don't care. Doesn't matter at all, because enough of our money was in the safe and steady investments to match the time horizon at the time that we wanted to take it out. So let's go back here. Okay, that's short term. So if we're approaching retirement, maybe we are retired and we're worried about stuff, we say, okay, worst case scenario, I've got all my money invested in the market. What's the very worst that can happen? Let's say there's a market crash. How much cash do I need to live off for the next 3 years, maybe? Because markets will, generally speaking, recover in that period of time. So worst case scenario, there's a market crash. How much money would I need to live on for 3 years? Okay, we could decide, well, that amount of money, I just put that in bonds. That's the money that, if there's a worst case scenario, then that's the money that I'll use. Okay. Right, medium term. Generally speaking, 3 to 10 years. It depends, on the individual. But we're not talking about that sort of default 10-year plus horizon. So our investment solution is now a proper globally diversified portfolio. As mentioned, low-cost index tracking funds in general, and an accent more on the developed market than the emerging. Let me just explain what I mean by that. So let's look at this. Let's look at this chart again, because although over a 20-year period the more volatile investments have done well, over any particular shorter term, there are plenty of 10-year periods where we may not have got the returns that we would have expected for taking a risk on the more volatile investments. Okay, so emerging markets, maybe Asia Pacific, maybe small cap. We wouldn't necessarily want to be putting all our money in this. So if our time horizon is medium term, then we'll be more of a focus with our equity part of our portfolio more on developed markets than the emerging, because we might need to take some of that money back in a time horizon where those markets are in their down cycle. Okay, the risk control methodology, it's all about the bonds equity split. So we want a split between bonds and equity that's in line with our investor risk profile. And what we're doing is we want to allocate enough to high quality bonds, so government investment grade bonds, so that we can sleep well at night. Rule number one, as investors, we want to be able to sleep well at night. And if we've got enough in the safe and steady, actually, again, we don't care what's going to happen when there's a market crash, because you think about it, there's a market crash. We've got enough of our money in bonds, maybe with those 3 years of living, because we're retired or whatever. But with all the rest of our investments, it's time to go investing, because that's investments cash that we don't need. We know the best time to buy shares is after there's been a market crash, so we should go investing, live off our bond holdings, and go investing with our equity, go investment shopping for equities. Okay. Similarly, as our time horizon gets longer, we've got a long term, a 10-year plus horizon. What are we talking about? Ultimately, what we're looking at is building future wealth. If we can pretty much, safely say to ourselves, well, you know what, I'm not going to really need access to this for 10 years. So this could be a pension, it could be a super, it could be money. that we're putting away while we're on contract overseas, whatever it is. We want it to grow nicely, okay? But it's future wealth. So what's our investment solution? Our investment solution is, again, a globally diversified portfolio, focus on low-cost index trackers, but more geographic accent on that longer term stuff. So more on the Asia Pacific, more on the emerging markets, because these are the areas where, yes, investments are more volatile, but we've got the time to wait it out and get the growth, the long-term growth that these assets deliver for us. So the risk control methodology, yes, we're starting with the right bond equity split, but we want to allocate enough to bonds, but not too much. Yeah, it's money that we don't need to see, maybe for 10 years. Let's make sure that enough of it is being put to work for us. Okay, what's the worst case scenario? Worst case scenario? Well, actually, there isn't any worst case scenario. So there's a crash. Doesn't matter, I don't need that money for 10 years. Actually, what I might want to do is rebalance, take out some of those bonds, take that money out of my back pocket and go shopping for more equities because there's going to be a rebound. So if we've got long enough time horizon, there's really no worst case scenario. It's really just a question of making the decisions of how much do I want in this quadrant up here, how much do I want in this quadrant right here. That's the essence of portfolio construction. Okay, so now I'm going to look at an actual specific portfolio just as an example. Stress, none of this is a recommendation. This is just an example, and I'm building this example on a theoretical investor. And my theoretical investor looks like this. I happen to do a lot of work with Australians, and my hypothetical investor in this case is going to be a mid-40s international professional. He or she is an Australian citizen but based overseas, likely to return home in a few years. But no, not necessarily any plans to access funds, for the next 10-year period. Most of existing assets are really home market, so we've got a bias towards the home market. And much like every nationality, when I work with Brits, their investments tend to be FTSE 100 companies. When I work with Aussies, their investments tend to be from the Australian stock market. So as investors, generally, we have a bit of a home market bias, this Australian investor is moderately in adventurous as a risk profile, and I'll explain what that means in a second. Okay, so there are literally, must be hundreds and hundreds of different types of risk profile questionnaire designed to help an advisor and a client have a conversation about the client's attitude to risk. And that could be an advisor that's a real person speaking to you, or it could be some kind of questionnaire that you're doing with some robo service online. But basically the objective is to try and have a conversation so that the investment recommendation really is appropriate for you and your own individual risk profile. So if we were to think simplistically of a 7-point scale, 1 is very, very defensive, gold bars under the bed, or what have you. 7 is very adventurous, so putting your money on some old nag on the race course on a Sunday afternoon. And 4 is in the middle, balanced. Have a think. Where might you see yourself on that scale? And it depends on a lot of factors, not just our inbuilt attitude to risk, but maybe what has our previous experience been as investors. What's our time horizon? How knowledgeable are we as investors? Loads of different, and the amount of money that we're investing. What percentage of our overall net worth is it? If we lose it, are we still at work, for another few years ahead, to be able to make that back again? So this is just one very simplistic way. Personally, I find it useful to have a conversation as a start point. Okay, so again, an example only to aid in a conversation. But if we were moderately adventurous, and by the way, it just so happens that generally speaking, the majority of investors, of course there are some down here and there's some up here, but on average people tend to be between this sort of like 4 and 5 as investors, because we don't want to put all our money at risk, but we want to beat inflation by a few percentage points. So a 5 out of 7, so a moderately adventurous investor. For an investor like that, we might theoretically have a split of about 1/3 to 2/3, or 35% safety, so bonds and cash, 65% growth, so equities. These aren't exact numbers, they're just designed to indicate where the range is, because it also depends on the types of investment that we're holding inside the two sections, so bonds and equities. But as a kind of a ballpark, if we've got a third of our money safety in bonds and cash, and 65% in equities, we might consider that as a moderate, suitable for a moderately adventurous investor. Okay, let's get stuck in. So now the next step is to select the funds, the actual investment funds that we're going to use to put together and reflect the asset allocation that we want, that we feel is right for us as investors. Okay, now this is to do the job properly can end up being extremely time consuming. It's detailed, it's iterative, it can take a long time to do the right job, particularly if your circumstances are unique. Maybe your advisor is putting something together for you that is customized, it's bespoke for your particular needs. Maybe you've expressed an interest in certain regions of the world or certain industry sectors. To build a portfolio properly is time consuming. There's no way around it. So finding and researching funds, analysing the combined roles of funds in a portfolio, you need the professional tools, you need data, and you need the tools to help you do the job. There are several tools out there. I use one called Financial Express Analytics. It's been around for a long time. A lot of professionals in our industry use it. They have data for over 300,000 instruments, including not just the historical performances, but the breakdown, the composition, that allows you to do all sorts of analysis. So risk return analysis, correlation between different funds, the holdings composition, so that we can make sure we're not being over concentrated. We can do fancy stuff called efficient frontier reports, and of course we can do the charts and generate reports that look all nice and fancy and have all the information in there. So we're presenting them to our clients, all that kind of stuff. So plenty of other tools. This is one of my favorites. I do use some others, but this is a key one. Okay, right, criteria for fund selection. This is just some of the criteria. I've tried to sort of capture the major ones, because ultimately what we're looking to do is reflect the equity bond split and cover the major asset classes. Okay, so we want our funds to distribute well across that risk return line, especially if we're talking about just core holdings. What do I mean about that? Let's just go back to that here. If you look, we've got, you kind of blur your eyes. In an ideal world, these would kind of like make a nice line, slightly flattening of the curve at the top end, because as we take more risk, we get less and less incremental returns but we kind of got a straight line. So if we can choose a range of investments that are properly diversified and they lie along this straight line over a workable investment period, it makes our life a bit easier, because it makes it more easy to reflect a volatility versus return profile that might be appropriate for us as investors. So let's just go back to that. Okay, so we want them to distribute well. We need them to be genuinely diversified. By genuinely, what I mean is, we don't want like 5 or 6 funds that all cover the same type of asset class, because we're just kidding ourselves if our funds are holding a lot of the same constituents. So we're looking to reduce concentration risk by making sure our funds don't hold too much of the same assets. So in general, what we're saying is, all else being equal, of the two, if we're looking at two funds, we'll prefer the one that's got the wider geographic and sector mix. So if we've got the same performance, the same risk profile, on average, I'll have the one that's got a better mix of investments, better, wider geographic coverage. Okay. Next, reasonable size and established track record. Now, you'll get, if you've got really small funds, haven't been around long, maybe there's more risk of infant mortality in the funds. Not that we'll necessarily lose our money, but we might have to sell out and buy a different one, whatever. We like funds that are reasonable size, and typically anything plus 200-300 million and above is quite respectable. Several of the popular global equity and global bond funds can be in the billions and billions and billions. And we'll have a look at that in a minute. We also like a nice track record, so they've been around for a period of time. That's good. Passive funds are fine because although they're tracking an index, you get something called a tracking error where the fund itself may not exactly perform the same way as the index. So if the fund has been around for a while, we can see what that tracking error is. We can also, for active funds, so managed funds, we can see how well have the management team been doing their job over that period of time. Okay. We like lower volatility, obviously, because the essence of portfolio construction is to sacrifice potential returns by, on one hand, reducing volatility on another. If we're 20 years old, we've got a 40-year time horizon, we don't care about the volatility, but if we're approaching retirement, we do. We're just trying to get that balance right. But on average, if all else is equal and we got two funds that are pretty similar, we'll have the one that's got that exhibits the less volatility, less up and downiness. Okay, lower cost. Research is very clear in this. On average, lower cost funds tend to do better. Kind of stands to reason, really. All else being equal, of two funds, we'll prefer the lower cost one. Correlation. So looking at the correlation between the different funds in our portfolio can be key when we're putting our portfolio together, because different asset classes, although nominally they might be different, they do tend to behave in quite the same way. We want to try and minimize that if possible, because we're trying to remove the extent to which, reduce the extent to which our investments all move together. If something is going up and something is going down and they kind of balance out, we've got smoother performance. So we look at correlation. Obviously, accessibility. There's no point in researching wild and wacky investments if we can't get them through our investment account or our investment platform. And finally, on currency, and I'll come to currency risk in a couple of slides' time. On average, we shouldn't let currency really worry us too much. We just want the best investment funds that we can find. But it's helpful to keep the number of different currencies that we use in our portfolio to a minimum, because if we've got Euro funds, pound sterling funds, US dollar funds, Singapore dollar funds, whatever, and we're moving our money between them, we've got transaction costs and friction every time we move our money around. But if all of our funds are in US dollar and maybe one or two others, as we move our money from one US dollar fund to another, it reduces the currency FX costs and friction. Okay. Right. So taking account of all of this, here is for our hypothetical Aussie investor. Here are the funds that we're selecting, and it's 10 different funds that we're selecting that we're going to use in a mix to give a nice diversified portfolio to reflect the risk return profile that we're comfortable with. Okay, so let's go down. So we've got, and we can see this is 5 years worth of data to last week, the 31st of December 2021, and the performance. So we can just start from the top. So NASDAQ. So the NASDAQ 100 is the largest 100 funds on the NASDAQ, excluding financials. tends to be traditionally very technology, media, telecommunications type firms, so very technology oriented. The next fund, and you can see I've listed whether they're passive or active, and you can see that the next fund is in fact the only passive fund, the only active fund that we've got in this portfolio, happens to be Asia Pacific, which is an area where you do get there are a number of very good long-standing actively managed funds in that region. And often you might use them because the indices around that are available don't reflect the split between, for instance, emerging and developed countries of Asia Pacific, because it's a broad region. So Ballygifford Pacific, Asia Pacific ex-Japan fund. Over 5 years, it's delivered in Aussie dollar terms. By the way, all of these are in Aussie dollar terms because we're an Australian investor. 189% over a 5-year period. NASDAQ, by the way, I didn't mention, almost 245% return. Remember, 200% return is tripling our money, so NASDAQ has done really pretty well in that period of time. Next, we've got so it's a variant based on the MSCI World Index, which is our sort of the most popular benchmark of global equities. It's the MSCI World Momentum factor, and momentum is one of the ways that we can kind of tilt our investment strategy. It includes and momentum, if you think about it, is it's the propensity of an asset to continue in the direction that it has most recently been in. So if a stock has been going up the last 2 or 3 days, on average, statistically, chances are it will go up again tomorrow. That may be our best guess. So that's momentum. Obviously, a lot more complicated than that. So it's a little bit more risky than the developed world. But the assets in your MSCI World Momentum Index will be pretty much the same as your developed world, but there'll be a bias, a tilt towards those that tend to exhibit higher price movements. Okay, so when we're in a good market, we'll get better returns from a world momentum. So the next one, global developed market. So this is D, the pink line here. So this is global developed markets, and this is momentum. So you can see the benefit of being more tilted towards momentum. Here's D, global developed world. So all we've done is just tracked the world equity index over the last 5 years. We'd have almost doubled our money in a 5-year period in Australian dollar terms. Okay. Next is the world small cap, so the MSCI World Small Cap. So this grey line, global smaller companies, and we can see here E. Global small cap over the last 5 years has actually underperformed the global index over that period of time. So although we know from our 20-year chart that global small cap, for instance, is one of the top performers, in any particular period of time, it may not perform as well as global equities in general. That's why we might consider it more of a satellite holding than a core holding. And then we've got gold. Okay, so we've got this sort of pale greeny type colour here is gold. So gold is actually up 50% in Aussie dollar terms over the last 5 years. And then we've got our 4 bond holdings. So we've got in Treasury inflation protected securities from the US government. So they're inflation linked. So the idea of this is like a bond, but they're adjusted to reflect a reduction in purchasing power of our money over time due to inflation. In fact, we've got 2 inflation protected holdings. The other inflation protected is this Australian government inflation linked bond. Then H is our Vanguard US investment grade credit, so investment grade bonds. And down here at the bottom, we've got global corporate bonds. Now, we've got 4 bond holdings, and they kind of zoom out. They all seem to be doing, blur seem to be doing similar, but we can see we've got 21%, 24%, 25%, 28% performance over that period of time. Little bit of a blip during the pandemic terms, but in the main, not a lot of volatility. And just wanted to point out that of our 4 bond funds, 2 are actually US dollar funds. So the iShares and the Vanguard are actually US dollar bond holdings, whereas the iShares, these 2 iShares are Australian government in Aussie dollars and global investment grade bonds hedged to Aussie dollars. So these are Aussie dollars and these are US dollars, and it's important, and I'll come to that in a slide or two. Okay, let's just have a look. Let's plot these 4. So this is one way of looking at the performance of our holdings. Let's just look at our risk return chart. Okay, so remember we've got risk along the bottom, and we've got return up the top side. So, and again, we're looking at the same period of time. So 5 years exactly to last week, 31st of December 2021. No surprises. Top right hand corner, we've got the most volatile investment is also the best performing. So there's our, actually I printed this a day after I printed the slide ahead, so the numbers are slightly different. 246% return in a 5-year period. At the other end of the other quadrant down here, J, we've got only 4.8% volatility, but only 21% returns over that period of time. And we've got a mix. So you can see where is our D, our Developed World Market Index, Developed World Index. So D, if all we done is just bought a tracker for the MSCI World Index and just held it for 5 years, we'd have delivered this performance. So we would have got 100% return, doubled our money, but we would have had an index, and this is in Aussie dollar, so we would have had volatility in Aussie dollar terms of 10.8. So you can see, again, we're only looking at a 5-year period. If this was like a 10-year or a 15-year or a 20-year period, we'd have had much more time for these data points to kind of smooth out and form along that line. Now let's look down here, E and F. We've got gold, and we've got E is that small cap, so the grey is that small cap. So if you remember me saying, hasn't done quite so well as global equities in general, but more volatility. So it's down there. If this chart, we were plotting this chart for 20 years, it would be up here. Okay, right, let's go on. Right, we talked about correlation. So thought I'd print you out a correlation table. Let's give it a quick look. So it's a bit like people don't use road atlases anymore, but in the old days in the UK, we used to have an AA road atlas in the back of the car. And this is a bit like a mileage thing between 2 cities. You pick your 2 cities, and the number in the middle is the mileage between them. So it's the same here. We pick our 2 assets, and the number in the middle is the volatility, is the correlation. So interestingly, and by the way, we've got positive correlation, which is indicated by purple, relatively low correlation indicated by green, and negative correlation indicated by this sort of reddy salmony colour. So correlation, remember, is the extent to which the 2 assets will move together. If one is moving, the other is probably moving in the same sort of direction. So negative correlation basically means if one asset is moving one direction, the other asset is moving the other direction. So that can be quite handy for smoothing out. In general, we don't necessarily see a lot of it, but the interesting thing to see is that gold has actually here given us negative correlation to a little bit against world small cap over the last 5 years. Asia Pacific, relatively low correlation with pretty much all other types of investment over that period of time. Same with our 2 what have we got here? So we got our global corporate bonds hedged to Australian dollars. Then we've got our Australian government inflation-linked bond. Again, sea of green here, relatively low correlation of these funds with other asset classes. So next is our NASDAQ 100, and higher correlation, no surprises. We're talking about equity, a large cap on NASDAQ 100, correlating with a high correlation of 0.82 with our developed world equity index. Similarly with the momentum index, the world momentum index as well. They're all global equity stocks effectively. Let's look down here. So there's our developed world. In fact, you can see the same thing. Okay, so in and of itself, it's useful and interesting. But if we're going through an iterative process and we're making some comparisons between different holdings, it can be useful to help us identify funds for inclusion or exclusion when we're going through that process. Okay, now let's come back to that to the reason why we've got Australian bond funds and US dollar bond funds in the same portfolio. So we'll talk a bit about currency risk in a minute, but let's just look when we print these charts out. So if I go back to this chart, this is printed in Aussie dollars. You can see these numbers are in Aussie dollars. So even if the fund is in US dollars, the performance is given in Aussie dollar terms. So in other words, the currency effect is already taken into account. And if we look at J and I here, these are our Aussie dollar denominated bonds, and H and G here are our US dollar denominated bonds. So when we're looking in Aussie dollars, it looks like our Aussie dollars bonds are a lot safer. Our US dollar bonds are a lot more volatile for pretty much the same kind of performance. But the other way around, if you go back here, the other way around, so this is exactly the same data that we just looked at. I've just compressed and zoomed in a bit. So here's our Australian dollar denominated bonds. Here's our US dollar denominated bonds. If we, however, redo this chart and base it in US dollar, hey presto, we get exactly the reverse, and no surprises, because if the US dollar is volatile against the Aussie dollar, then by default the Australian dollar is volatile against the US dollar, if that's our benchmark currency. The interesting thing is, though, is that we still see a little bit better performance. Marginal, but still worth writing home about over a relatively short period of 5 years. So we would have got 30% returns from our iShares US dollar inflation protected bonds, and 26% returns in US dollar terms from our global investment grade credit fund from Vanguard. Okay, now why do we do that? Because although Australian dollars may be our home currency, we want to diversify in currency terms on our bonds, in currency terms, and I'll come on to that in a second. Okay, now why have we got that diversification? Now it's just like random chance. I printed this off the other day. Over, what have we got here? So we've got this is 2000. Okay, so this actually isn't 5 years. There's a typo up here. That we look here when I printed this out. So 29th of December, back in 2006. This is a 15-year period, not 5 years. Since then, the Australian dollar has got this is 2016. Okay, the date's wrong. Okay, this is a 5 year period. I've got the wrong date in here. Okay, so over the last 5 years, the Australian dollar has got relatively stronger, as appreciated against the US dollar. then there's been that gradual decline, then it's absolutely dropped through the floor during the pandemic crisis, and then has recovered a bit, and then it's come back down. And by absolute chance, it just so happens that the Aussie dollar against the US dollar, like this week, is exactly the same pretty much as what it was 5 years ago. And that's for economic reasons. It's also just for market reasons associated with the pandemic. So usually what you'll see, and we saw it in the global financial crisis, is when everything hits the fan, it's the US dollar that people revert to, because it's the foundation currency of the global economy, at least for the time being, and will continue to be so for the intermediate future. But things recover back quickly. So this volatility we see now, if we let's move on. Okay, so I'll go straight on to currency risk, and we'll come back to why that will cover why we hold different currencies in our bond holdings. So currency risk. Hopefully you're still with me. My coffee's gone cold, but I'm enjoying myself. Hope you are too. Okay, currency risk is a bit of a tricky thing sometimes to get your head around. And not just for ordinary investors, but to be honest, sometimes advisors don't quite get their head around it too. But once you do have your head around it, the concept is very easy. So as an investor, it's important to understand what our reference currency is. And our reference currency, the best way to think about it, it's the primary currency of our future expenses. So if I'm an Australian, in a few years' time I'm going to be back in Australia, spending Australian dollars for my groceries and to deposit on my house and put my kids through school, my reference currency is the Australian dollar. But if I'm a Brit going to return home into the UK, it might be pound sterling. Or maybe I'm any nationality, and let's say I'm a Brit, I'm going to return and retire in Spain. My reference currency might be euros, because I'm going to be spending euros in the future. Or, maybe I'm Indian, but I want to send my kids to school in France in the future. My reference currency for that particular expenditure would be euros, not the Indian rupee. So first step is to understand what our reference currency is. And where does currency risk come from? So currency risk comes from the potential foreign exchange variations between our reference currency and the valuation currency of the underlying assets that we hold in our portfolio. Okay, let me explain by that. So let's say I want to buy, I want to buy this cup of cold coffee. Okay, let's bring it into camera. I want to buy this cup of cold coffee. Okay. And I can buy that coffee. I can't buy it directly. I have to buy it through an investment fund. And the investment fund happens to be denominated in US dollars. Okay, so I give the investment company my US dollars, and the investment fund goes away and buys one cup of cold coffee. Okay, I've invested US dollars, but now I actually own coffee. Okay, or I could buy it maybe through a different route. I could buy through another investment fund that happens to be denominated in euros, and I give them euros, and they go away and they'll buy the same cup of coffee. So again, I own a cup of cold coffee, but I've invested euros. So now my home country, my home currency, let's say I'm a resident in the UAE. I'm going to be here forever. For the period of this duration, my reference currency is actually dirhams. So have I got US dollar risk? Have I got euro risk? Or have I got dirham risk? So actually, I don't own US dollars. I don't own euros. I own a cup of coffee. So my currency risk is the foreign exchange risk between this cup of coffee and dirhams, because that's what I want to be selling in the future. So when I'm investing, it's the currency of the underlying assets that actually really creates our currency risk. So let's give you another example. So an Asia Pacific fund, if I want to buy I want to expose you to Asia Pacific by buying an investment fund. But Asia Pacific will hold a basket of investments across Asia. So maybe China, Hong Kong, Singapore, Vietnam, Cambodia, Malaysia, Thailand, Indonesia, whatever. So if you're buying shares on those stock markets, the shares are all denominated in their home currency. So if I put my US dollars into Asia Pacific, I'm not actually holding US dollars, I'm holding renminbi and rupiah and all the different kind of Thai baht, all the Singapore dollars. So my currency risk, is against that basket of currencies, not against the US dollar that I might have invested. So another example. So a world equity fund, MSCI World Tracker, might introduce a currency risk, but it's against a huge mix of international currencies. If we're investing in shares across 22 or 24 of the major developed markets of the world, we've got all of those currencies expressed in our basket. It doesn't matter what the currency of our investment fund is. The currency risk against our home currency is pretty much the same. Noting that US investments tend to represent, for a global equity fund, 50% plus of the global market cap. So our currency risk will be more weighted towards the US dollar. That's fine if our reference currency is US dollar, but we need to be just a little bit aware of it if our reference currency is something different. But in general, what we're saying then is kind of, okay, forget about currency risk for our equity investments. We just let the asset allocation do the work. Because if we're investing globally, we've got investments in so many different countries and so many different currencies, we really don't care. And if you think about it, the currency markets are a zero-sum game. If you take all the currencies in the world, if something is going down, something else is going up against it. And that's happening across, all the 100 or so, key currencies, that we might be invested in. So it's basically a zero-sum game. All we want to do is just make sure we're choosing good investments that give us that diversification within our portfolio. Okay, whoops. So generally speaking, I won't cover it now, but generally speaking, currency hedging equity funds isn't particularly helpful. May be helpful for bond funds, and let me just come to that. Okay, so for bond funds, remember our bond, when we buy a bond, we're loaning money to somebody, and they promise to pay us back a coupon or an interest rate in the currency that we've lent. So a bond is a cash-like instrument. So if we're lending Australian dollars, we're going to get our interest rate paid in Australian dollars. Okay, that's fine if we're an Aussie investor, but maybe where we want to lend in US dollars to get our interest payments back in US dollars. Okay, so we'll then have introduced a bit of a currency risk potentially between Aussie dollars, our reference currency, and US. So bonds are cash-like. So we need to make sure that we are holding enough funds denominated in our reference currency, because if we suddenly have to go back home to Australia and we need cash, we need to make sure that enough of our money was actually in the currency that we want to withdraw and spend, i.e. our reference currency. Okay, so a typical Australian investor returning home needs to make sure we got a relevant portion of bond holdings denominated in our reference currency in Aussie dollars. And then currency hedging can sometimes be useful. So if we go back, let me just show you this fund. So if we go back here, the one down at the bottom, so the BlackRock iShares Core Global Corporate Bond Hedged AUD. What does this mean? So this fund tracks the performance of bond markets in different currencies. So UK, Europe, Australasia, US. So a mix of different corporate bonds, which by definition are denominated in different currencies. So here, to get rid of some of that currency risk, we're just going to hedge it back to Australian dollars. So what that does is takes out the currency risk of the volatility between the Aussie dollar and those other basket of international currencies. Okay, right, let's go on moving forward. So that's currency risk. That's really all we need to know. Don't care about it for shares. It can be helpful for bonds, and we need to be aware of it against our reference currency. Okay, moving on. I can see I've been talking 1 hour and 35 minutes. Thanks for sticking with me if you're still here, or welcome back if you've gone away for a coffee break or whatever. Okay, now we've got our 10 investments. Let's build a sample portfolio. In fact, we're going to build 4 portfolios because our investor is moderately adventurous, but we want to see how the different portfolios behave based on different allocations to equities of 50%, 60%, 70% and 80%. Remember, the more equities that we hold, the more adventurous our portfolio is. So let's just plot them out. So because we've already now chosen the investments that we like for this portfolio, we can actually build 4 versions of the same portfolio. I've highlighted in red the 70% equity, but we can see the percentages changing there. So if we look, we've got 70% equity or growth oriented, 30% bonds and gold in this case, which is the safety part of our portfolio. So we can create 4 different versions of the same portfolio. And once we've done that, because we've got the tools, we can plot it. And I first plotted it on our risk return chart, so returns versus volatility. Now things are really starting to get interesting, for me at least. Okay, here's our world index. So that grey line D, there's the MSCI World Index. Again, we're an Aussie investor, so we're doing everything in Aussie dollars. The world index over this period of time, and this is 5 years, exactly to last week, the world index has generated, there's our 101% doubling our money in 5 years with 10% volatility. If we'd have not invested internationally, but we just bought a tracker, an index tracker of the Australian index, the ASX 200, we would have got 59% growth in Aussie dollar terms with a lot more volatility, 14% volatility. So we can see, the relative performance between a global equity index and an Aussie home bias equity index. So we've got a home country bias by not having an international perspective. And it's not just Australians, it's every nationality. We like to think we're being smart by investing in what we know, but we miss a trick because we're missing the opportunities that are out there away from the boundaries, the borders of our own country. That's just the penalty for home country bias, actually more volatility and less growth over that period of time. But let's look this direction. Here are our portfolios. So we've got A, B, C and E. So A is our 80%, B is our 70%, C is our 60%, and E is our 50% equity portfolio. And you can see, simple, almost linear, as we reduce the equity and we increase the bond holding, we've got a nice smooth line as our portfolio performance reduces in volatility with an equivalent reduction in return. Okay, now the interesting thing is that, let's look, I've circled B, the 70% equity. The performance has beaten the global performance, but the performance has beaten the global performance by 15%-ish, with 8% volatility versus 8.1% volatility versus 10.6. So we've reduced volatility, but we've got better performance. And we remember with this one, we've got 30% safety, so there's 25% in high quality bonds and 5% in gold, and the rest is in equity with this portfolio, and we've still beaten the world index. And that's what we call diversification benefit. So the benefit that we get in the overall statistical performance of our portfolio, that is, it's very clear cut, and that's what the essence of portfolio construction is. Okay. Let's look at it another way. Same data, same time period. 5 years to last week, the 31st of December. Here's that same data. So now we can see, if we look at the brown line at the bottom, the Australian, the ASX 200, we can see, pretty high volatility, reacted, pretty drastically to the pandemic outbreak, but has recovered, since then. But if we look at our 70% portfolio, the green line, 70% equity portfolio, the green line, there is B up there. So we can see, yes, of course, for the higher equity, we will in general see more up and downiness, more volatility, and for the lower equity holdings, so the blue line, for instance, is only 50% equity. The peak to trough for that blue line there is a lot less than the peak to trough for that orange line there, in percentage terms. So if we're holding these two portfolios at the time that we went into the pandemic, this one proportionally would have lost less, but wouldn't have recovered, quite so nicely over that period of time. So when we're looking at a chart like this, we can then have an internal conversation with ourselves about, okay, if that was me, would I be comfortable with that amount of volatility in the assets that I'm holding? And, again, just to reiterate, I happen to have circled the 70% equity fund. So 70% global equities, 25% high quality bonds, so government and investment grade, and 5% gold. If we'd invested 1,000 Aussie dollars 5 years ago in this exact portfolio, this is real world data, it would have grown to 2152. There's that 2152. That's an annualized rate of 16.5%. Now, drop money in there, take your money out there, 16.5%. You'd have needed, if you were putting it into a bank, you'd have needed to get 16% per annum, 16.5% per annum from your bank to generate the same rate of return. That's not too shabby. Of course, no guarantees, but as an investor, we're now looking at these. Okay, do I like that? Am I happy with that level of volatility? Am I happy with knowing that 25% of my money is in the safe and steady? It helps us, a chart like this helps us, and also this helps us have that dialogue with ourselves and choose where we want to be as an investor. Okay, now just out of interest, Vanguard, very famous name. I love Vanguard. They're one of the trailblazers in low-cost index trackers, of course. Vanguard Australia happened to have a range of diversified multi-asset ETFs available to home Australian investors. And just for interest, not to have a knock at them, but just because I was interested, I plotted the performance of the Vanguard funds on this same chart. So that chart, now I've added the Vanguard funds. Okay, and here they are. Now, Vanguard funds, they've got one called Balanced, which is a 50% equity fund. And they've got one called Growth, which is a 70% equity fund. And then they've got one called High Growth, which is a 90% equity fund. Okay, so so interestingly enough, the Vanguard Growth at 70% equity would be in theory equivalent to the portfolio that I've been highlighting, the 70% equity fund. So let's actually see how things have done. So here we've got, where is our fund? So B is here. This is our 70% equity fund, and Vanguard Growth. There it is H. So there's the Vanguard 70% equity fund. So quite a big difference in performance. Now, remember, we're not looking just for performance. There's a whole menu of things that we're looking for when we choose our funds. But maybe we'd be happy with this performance if we were giving up performance for the sake of reduced volatility in our portfolio construction. Maybe we don't care about what's going on in the big wide world. We only want homegrown, Australian domestic investment because we only think in US dollars. So we can actually replot this chart here. So here we are. Here's our three Vanguard funds now plotted on the same chart. So there's our world index, there's our ASX 200. Here's the portfolios we've just been discussing, and here's the Vanguard portfolios. So interestingly again, we can see, so there's B, there's our 70% equity portfolio. There's H, there's the Vanguard 70% equity portfolio. And we can see, clear as day, Vanguard fund slightly more volatile, a lot less performance. And again, not knocking the funds that have a purpose. But if you go back right to the very beginning, one of the first things I said is, big names, low cost, doesn't necessarily mean they're always the best funds for us. But the Vanguard funds might potentially have a role as part of that core holding if we weren't bothered, or we didn't want to build our core holding ourselves. We just wanted to buy a fund that did the job for us. Okay. So let's move on. Here's a slide. If you want to have a look at the detail, just stop the video and look at it for a second. The individual performances over a 5-year period for each of the funds that we're holding, and we can see, the Nasdaq at 246% returns in a 5-year period, versus the worst performing one is our Aussie dollar hedged global corporate bond, so safe and steady, 20%, 21% returns over that period. Moving on, we can look at our portfolio breakdown. Our portfolio, this is for the 70% equity portfolio, 41% North America, global fixed interest, so this is global bonds, 22%. I think this other down here is probably money market or maybe even cash holdings, so that makes up our 25%. Commodity and energy, here's our 5% gold. Asia Pacific here. So we've got Asia Pacific emerging and Asia Pacific in general. Remember me saying there are Asia Pacific equity indices that we could attract, but I like not just the Ballygiffy, but there are a few others that I like as an actively managed fund that gives the kind of exposure to the countries that I'm interested in as a follower of Asia Pacific. And here we can see our breakdown. TMTs, undisclosed. A lot of funds sometimes won't necessarily give the level of data that helps us break this down. There's our government bonds, consumer products, blah 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 blah. Healthcare at 4.3%, perfectly fine given where we are. Precious metals and stones, no stones. This is that gold. Okay, moving on. Okay, portfolio cost. One of the big things about the research that comes out of evidence-based investing is a correlation between low-cost investments and long-term performance. But it's not as black and white as that. And remember, you can't just say, oh, because a fund's cheap, it's the one that we want. And it's particularly ridiculous to rule out, all unit trusts and mutual funds because they don't have a place because they're not cheap enough. And as you've already demonstrated in this particular case, we've got a fund that is actually a lot more expensive, several times more expensive than some of our other funds, but it plays an extremely valuable role in the portfolio. So let's just explain what we're looking at here. So fund managers, depending on the territory they're regulated in, they have to declare the costs internally built into the fund to pay the operational fees of the operational costs of the fund and also the management fee. So we have things like fund management fee, ongoing charges figure, total expense ratio, annual management charge. They're all slightly different ways of saying the same thing. The OCF tends to be one of the more catch-all ones, but basically this software that I use will analyze them and work out actually what's the weighted average cost of this portfolio. And you can see down here, we've got a 0.1 or a 0.12 OCF on some of these. iShares Tips is 0.1. Our bond funds are 0.25. We've got 0.25. Nasdaq is 0.3, and Ballygifford is 0.7. But blended in a portfolio, our overall portfolio cost is only 0.32%, and that actually not too shabby. That's a nice. I'll be very very satisfied that as an advisor, I've done my job in trying to identify quality low cost funds that fit together in the context of a balanced portfolio that hits where we want to achieve. Okay, I'm on the downhill stretch now. I've been talking for 1 hour 45 minutes. I hope my screen recorder has actually worked and my hard drive hasn't jammed. A couple of questions. Why not high yield? These are things that I do get asked. So why not high yield bonds? So high yield bonds, do you remember me saying that high yield bonds are high yield because they're from smaller, more riskier companies? So they often have to offer high yield to their lenders, to the bondholders. Now, high yield bonds are fine, and I use them for a number of clients. But if we're expecting more volatility in the market or uncertainty in today's world, there's a lot of uncertainty. When markets are highly volatile, high yield bonds behave a bit like equity, because those companies, if I've got an investment fund that holds bonds of a lot of different companies, there's going to be a chance that some of those will default. And if equity markets are going down, more likely than not, some of my high yield bond issuers are likely to have a problem meeting their obligations. So if I want the bond part of my portfolio to do its job, which is the safety. So I will include investment grade, inflation linked, government bonds and treasuries, but I won't include high yield bonds. I'll use equities for that part of the growth portfolio. Gold, don't always put gold in. In fact, more often than not, I don't. I put it in here because I wanted to illustrate the how gold behaved in a negatively correlated way against certain investments. The way to think about gold is, the way I think about gold is actually not an investment. It doesn't generate anything. You're not participating in the global economy. It doesn't pay dividends. It has a cost to hold. So it's kind of like, it's not really investment. Gold actually the way to think about it is it's a currency. Some people say gold is a hedge against inflation because when all hell breaks loose, people will move towards gold. But gold actually, it's a little bit of safe and steady that gives us some reaction against market conditions, helps us smooth out a bit of volatility. And if worst comes to the worst and we need to take some out, if gold is high, then maybe we'll take some withdrawals from our gold holding rather than one of our bond holdings, whatever. And a final question that gets asked, periodically is how often, we got our portfolio, how often do we adjust our holdings? And the answer is actually not much. So if we go back to our core and satellite, if we've got a medium to long-term horizon, we've chosen a set of good quality index tracking funds for the core of our portfolio, we might just buy and hold these, for many years, unless there's a real reason to sell out. They'll give us those long-term percentage growths of the asset classes that we're holding. Now, if there's a major market crash, for instance, like after the global financial crisis, we might decide to, because we know there's going to be a rebound, so we might decide to sell some of our bonds and buy more shares with it. But actually, that process is called rebalancing. And rebalancing is a process of saying, okay, well, let's say we want 70% equity and 30% bonds. There's a market crash. Our equity is down by 35%. So now our equity is down by half. So maybe our bonds have gone up. So what that means is, if we still believe we want 70-30, we sell some bonds and buy equity to get back to that balance, and then we ride the wave back upwards. And we can actually do that, on a periodic basis every year to 18 months or so, or we can do it when there are major market movements. That's the process of rebalancing. Around here, remember, we bought into some of these asset classes because we like some themes. Maybe right now we like technology because of the pandemic. Amazon and Apple and Microsoft and all these guys are doing wonderful things with their online, and Netflix and whatever. So maybe we like that. So maybe we buy a technology fund or something or other. Or maybe we like biotechnology because we think, those boys are going to make some good money, capitalizing on the need for, medical advances to fight the virus. Those are more trend spotting. We're not trying to call market tops or call market bottoms, but if there's a trend that we think we've identified, we think it's got legs for a year or two, maybe we'll have a piece of it, 5% or a few percentage points of that particular asset. And if I go to how we built the portfolio, we can see we can see here. So let's look at our small cap fund. So 50% equity. I've only assigned 6% to small cap. We're in it for the long term, of course, but we want relatively cautious. Whereas the 80% equity fund, we've got double the holding in small cap. In small cap, because we're prepared to take more of a risk on volatility to get that growth that we're looking for. Okay. So 1 hour and 55 minutes. Thank you so much for sticking with me. It's a little longer than I was expecting, but hell, it's 42 slides. I hope it's been useful. Thank you for your time and attention. If you've got any questions at all, please do get in touch. This actual recording was originally going to be my dry run, but once it was going so well, I just let the recording run. So it has been a bit patchy and I hadn't fully prepared, but hopefully you got some value from it. And my final slide is an advert. Although I'm based in the UAE, I work with expats, all around the world. So if you think we might work well together, or you think I can be of some assistance to you, or you have any questions at all, please do reach out, either by my email, which is there, or my website, Roy Walker Wealth. And thanks again for watching, and I'm looking forward to hearing from you and being of service if you think I can. Bye bye now. Thank you.